Investment term for the day: cookie jar reserves. Cookie jar reserves are savings from previous quarters that a company records as earnings in subsequent quarters to make it appear that its earnings were higher than they really were. When a company fails to meet its earnings target, a company accountant can dip into the cookie jar to inflate the numbers. Needless to say, the practice of cookie jar accounting is frowned on by government regulators as it misleads investors in the company's performance. Wall Street values companies that consistently meet or beat their earnings targets quarter after quarter. Analysts rate them highly, and investors pay a premium for their stock shares. They tend to be valued more highly than companies that have the potential to earn spectacular amounts of money in some quarters but fail in others. Cookie jar accounting can be used to smooth out volatility in financial results and give a false impression of stability. One line item in company reports, special items, is a particular good place to hide a cookie jar accounting move. Special items may include any large payment or other income that a company expects to be a one-time event. Or it may be a chunk of money from a previous highly lucrative quarter that a company has hidden in the cookie jar and is now using to inflate a poor earnings number. An even more egregious variety of cookie jar accounting creates a liability in one quarter and then erases it from a subsequent quarter. For example, in a genuinely great quarter, a company might add a vague and probably mythical liability to its earnings report. It could say, record a $1 million liability for equipment it intends to buy. That $1 million liability goes into the cookie jar. The next time the company has a terrible quarter, it cancels its non-existent plan to buy equipment and lists the liability as income. One famous case of cookie jar accounting ended with the computer giant Dell paying a $100 million penalty to the Securities and Exchange Commission (SEC) in July 2010. The SEC argued that Dell would have missed analyst earnings estimates in every quarter between 2002 and 2006 had it not dipped into its reserves to cover the shortfalls in its operating results. In this case, the cookie jar reserves reportedly consisted of undisclosed payments that Dell received from chip giant Intel in return for agreeing to use Intel CPU chips exclusively in its computers. And that was your investment term for the day.